Schwab Advisor Services is a proud supporter of the RIA Edge Podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hello, everyone, and welcome to the RIA Edge Podcast. This is, as you know, hopefully by now, my chance to speak to the executives who are in the vanguard of the independent wealth management space, building out registered investment advisory firms that are in growth mode, sustainable growth mode. We want to speak to them about their decisions, their strategies, where they're investing their capital and their time, as they create professionally managed independent wealth management businesses and not simply relying on the ever-rising markets as a growth driver. It's way too volatile, as we've recently seen. Usually we speak to principals at RIA firms, but today I'm thrilled to be speaking to Jalina Kerr, the Managing Director of Client Experience for Schwab Advisor Services. I don't know of anyone who's spoken to more financial advisors than Jalina. So Jalina, thanks very much for joining us.
Well, thanks for having me.
I wanted to start with this market volatility of the past couple of weeks. Recently brought up a reminder that I think that the fortunes of most RIAs are tied to the markets, essentially, given the AUM pricing model. And I know some aren't priced by AUM, and we could talk about that a little bit later if you want. But I thought I'd start there by asking you about, from your perspective, the resiliency of the RIA model. If their fortunes are so tied to the markets, and we've seen such volatility recently, kind of a reminder of that connection, and markets don't always go up, and growth does not always go up and to the right. From your perspective, have the last couple of weeks shown us anything about the resiliency of the RIA space?
David, I think resiliency is a great term to use when talking about the RIAs. I've been in this industry for 3 decades now, and I feel like every time we have a market situation where there's volatility like the one we're experiencing now, RIAs demonstrate why they're a great choice. And it really becomes an opportunity. What I hear from RIAs quite often is we got more clients because of the way that we handle volatility and because of the relationships that we have with our clients. So really, these market cycles, as unpleasant as they might be for us as investors, generally allow RIAs to show what they're made of. And they do demonstrate through that depth of relationship that they are a calm in the port, so to speak, when clients are really feeling uncertain or uneasy emotions tied to the volatility. They really do shine. They're at their best. I mean, they're a great barometer all the time, but I always feel like they really rise to the challenge whenever we're facing this volatility. We'll see a period of volatility followed by a period of growth in client alignment or assets for RIAs, because they're demonstrating a calm demeanor in terms of how to navigate these ports. And usually during these times is when people are looking for more help rather than less help. So it can tend to lead to a bit of a growth curve for advisors.
Yeah, for sure. And I think we saw that out of the 2008 financial crisis, right? I think most RIAs who were around at that time said that they, came out of that with wind at their back. Investors were looking for answers, maybe upset with their previous advisors or brokers, whoever they might be, and were looking for new advisors. A lot of them benefited from the financial crisis.
That's exactly right. And I think when we think about the size of the RIA market now being somewhere in the neighborhood of $9 trillion, with the potential to more than double that over the next decade, those opportunities for advisors really expand each and every day.
Yeah. So we have a lot to talk about. I do wonder, from your perspective, I was just reading a statistic the other day that only about half of RIAs do kind of comprehensive financial planning. Now, that's probably higher amongst the advisors that Schwab works with, I'm sure. But is there some kind of this will be beneficial for those advisors that really step up to the plate and, put their best foot forward to do what they need to do for their clients and calm them down and show them the way through this period of volatility? Are there other advisors, though, out there who maybe don't have that capacity or don't have those chops? And what do we see happening there?
I think advisors right now, what we often hear from them, David, is that they know that they have to really start to lean into some of these other solutions and go beyond maybe where they've been for, say, the last decade or even 15 years in terms of broadening out the scope of what they do for wealth management. So it was one thing at a time to say, hey, we can really get you a great result. Our portfolio track record is strong. This is what differentiates us as a firm. It is now a different paradigm where clients are asking for more. They want beyond portfolio advice. They want to understand the broader picture. As you touched on, planning might be scratching the surface, especially as people are dealing with more complexity, as people are dealing with the generational wealth transfer. They're being confronted with real challenges, whether that's around tax planning, estate planning. How are they going to optimize perhaps positions they've held for a long time where there's a really low cost basis given the long and strong bull market we experienced for quite some time prior to this volatility. And advisors really have to be able to answer those questions more broadly beyond just here's how we construct a great portfolio. And so I think advisors hear that, they're up for the challenge, and many of them are leaning in here in a way I haven't seen in my many years in the industry, really trying to understand how they can weave those solutions together and really help be at the epicenter of that holistic wealth solution front.
Yeah, let's talk a little bit how they're weaving those solutions together. Because one of the things that we hear about a lot over the past couple of years has been this personalization at scale, right? Taking a 360-degree view of your clients and helping them in all kinds of ways, as you say, tax planning, estate planning, depending on the situation, perhaps even medical advice or whatever it might be. Advisors who are doing that, I've always had a hard time reconciling the personalization that's required for the kind of service you're talking about with this growth scale strategy, right? How can you be as bespoke and personal with each client when clients are asking for more? And, it just seems those two things are kind of at odds a little bit. Do you know what I'm saying?
Absolutely. I think that's really where advisors are looking, not just to the custodians for help, but obviously the ever broadening wealth tech ecosystem as a whole. We all have a responsibility to RIAs to figure out how to solve that interconnectedness challenge that they face, that we face. Because right now, I think what RIAs are doing are really trying to stitch together various point solutions. And it's hard to do that. It takes a lot of time. It takes a lot of energy. They know that scaling their firms is really critical to help move that growth needle that we were talking about at the beginning of our conversation. And you can even see it in some of the data that we see when we do the benchmarking survey that we do each and every year. The firms that are performing the best are spending 25% less of their time on operations and 10% more of their time with each client to really deepen the relationship, provide those extra services that we're talking about. And the only real way to unlock that is by scaling it and by really figuring out how do you whittle down that complexity of the tech ecosystem and how one activity begets the next, that begets the next. Stitching that together and making it really seamless is essentially going to be table stakes at not a point in the too distant future.
Speaking of this perennial problem with a lot of RIAs, where they're even in their tech stacks, right, trying to integrate everything and to bring it together, and never really seems to work well. What are you guys seeing in terms of the adoption of more, I guess, for lack of a better word, soup to nuts, all-in-one wealth management platforms? It seems to solve some of those issues of, spending less time kind of administrating the business and more time with clients. Is that something that you see advisors adopting more?
We do see an adoption of more all-in-ones. And I think at the same time, a realization that even those are not yet truly all-in-one. In a way, they really have to figure out, there might be a few things that are still outside of the ecosystem, or frankly, as all of us grow, just like we as a custodian have to consider the breadth as well as the depth of what we offer, so do the all-in-one providers. And so they too are challenged, I think, to say, how are all these things important? How do they go together? How do they maybe not go together? Because I think what we're hearing is that while there is a nod that that can be a path to simplification, I also think some advisors are challenging that paradigm a little and saying, maybe I don't need best in class in this one spot if I can stitch together two things that work really great and power the rest of the ecosystem. And I think a lot of that conversation is starting in the CRM right now. And so I think if clients are focusing on a CRM connectedness that helps them kick off these other parts of the wealth management lifecycle, if you will, I think that's really helping them make the right bets. Because I think if you look in the rear view, maybe 5-10 years ago, we were seeing a lot of advisors paying top dollar for all these best in class solutions, only to realize that, you know what, maybe best in class across a whole is not going to scratch the itch I particularly have, because each of these firms have unique needs. And so I do think it's highly personalized, but I also think it's interesting to see where some of them are going. Some of them are going to a place of less is more, not more is more.
Yeah, yeah. No, and you're seeing that amongst your advisors. That's interesting. I mean, it wasn't even that long ago, and probably some still. The CRM is basically their inbox, right? Their email inbox. But we're past that, I'm sure, for most. The in the benchmarking studies that you do, you talk about these additional services that advisors are bringing in board or in-house, or at least partnering with others to provide for their clients, because the clients are asking for it. What are tax planning? Obviously, a big one. Estate planning, a big one. How are advisors doing when it comes to adopting those tools?
Yeah, there's been tremendous growth in the utilization of tax planning, estate planning tools. Really, estate planning has just been on a bit of a tear, if you will, which is great because I think it's coming at the right time when you think about what artificial intelligence is doing for those sorts of tools. I think the rub has always been you have to sift through document after document to really get to the point that you need to, and then you have to generate more documents. And a lot of the technology that's out there in both the tax and estate planning space now is really truly fulfilling the promise of simplification there. Artificial intelligence is reading those documents, it's making recommendations, it's really taking some of the heavy lift out of it. Now, I say that not to say that it's fully replacing the people, because equally I hear from our advisors that as great as the technology is, they still need depth of expertise. Perhaps they're bringing a CPA on staff, somebody who has IRS designations, somebody who has the credentials to really make sense of what the tools are putting out. Mm-hmm. And I think it's a great example of how the tech has to work with the people in that space, because you still need that expertise. You still need somebody to really help guide the client and explain these things to them, while the tool is doing what the tool should, which is creating some scale and efficiency to what was previously a really labor-intensive process.
Yeah, no, it makes sense, and I've seen some of these estate planning platforms that are pretty amazing, and just even surfacing, suggestions. The things that I think most advisors, I'd like your view on this too. So, the tech portion has been not solved, let's say, but I mean, well on the way. The human conversation around some of these other non-investment topics, taxes, estate planning, are advisors still kind of struggling there a little bit? My impression was that most advisors, didn't come up in this world of estate planning or sophisticated tax strategies. Maybe are having conversations with clients who are business owners, or maybe just sold a business or something, and have some liquidity event, and where there might be real need for tax strategies or estate planning strategies, trust strategies that the advisor wouldn't even recognize. Right, those flags will go up in a conversation. The advisor won't know. To bring something in. Do you see a kind of a bifurcation of advisors who are, more familiar with those topics and able to bring those in-house versus the advisors who still don't have that education or aren't?
We do. There's definitely a spectrum of knowledge and expertise. And I think The recognition is there. I think some advisors who maybe are uh, not specialists in the ultra high net worth space, but have maybe grown into some relationships with, to your point, a client who sold a business. There's some sort of liquidity event that happens that creates the need for this additional solution. While they're recognizing they need it, there really is a spectrum of ways to solve it. I think larger firms may have an easier time of it because they can do what I suggested, which is maybe put some people on staff that are at the ready with that type of depth of expertise. But on the other end of the spectrum, we are hearing often from advisors that they would love to tap into a service of that nature because it's not something that they have to do every single day, but they certainly need that skill set or that ability to demonstrate what solutions could look like for those clients when they come up. And again, they could come up in terms of the client's growth. They could come up in terms of a prospect that they want to really try to win. And so they're in real time trying to piece that together. And I think if there were some better services that they could tap into that kind of marry both the tech and that expertise in the form of a human, that would be incredibly valuable to RIAs.
We speak to a lot of RIAs on this podcast, and I guess I too would have shared that same impression that the larger the firm, the more likely they are to bring that kind of expertise on staff. I'm surprised that many of the larger firms that say, yeah, we could, but we still choose not to because we want to keep the referral networks open, or we, want to be able to, as fiduciaries, go to the best provider that we can. Do you see advisors kind of grappling with this notion of, what's the best way forward? Do we bring that stuff in-house? Do we build it all here? Or are there still benefits to partnering outside?
I think it's a real tension point right now, and one that has been coming up quite a lot, I would say, over the past couple of months in conversations with advisors. They are, to your point, they're leveraging sort of that tax prep aspect of it to try to deepen a center of influence, maybe work the referral network. However, I think given the shortage of talent in that space and the fact that it's somewhat commoditized, it's creating a pressure point on that side of the equation when you think more purely about sort of tax prep as one arm of it. And then you go all the way to the other side and you think more about tax planning and strategizing really about potential tax solutions. I do think there it's hard because you want to create some optionality and pick an array, if you will, of providers that can maybe help support it. But I think many are coming to the conclusion that you might need to have one really deep partnership that you can trust, because at the end of the day, wherever I hear that there's a breakdown, it's usually because the provider isn't living up to the promise or the standard of service that the RIA has themselves. And it's a high bar. It's a high standard. That's why RIAs are a growth market and a growth industry, is because they do have that high standard. And I think in some places, the friction in that other side of the ecosystem related to tax has created some inconsistency that makes them uncomfortable.
That's interesting. Inconsistency in service or service levels, and I guess a risk, right, for the RIA if you're referring someone out and it doesn't work, or there's a bad experience out there that you can't control. I could see that being a problem.
Exactly. Their brand is an extension of your brand, and if it's not meeting the need, that's not the way anybody wants to show up.
Yeah. So let me, you see these trends and where they're going. Maybe I could give you just a opportunity to talk a little bit about the roadmap that you all are building there, or, where you all are at in terms of the tech providing to advisors. What's the advisor, Schwab Advisor Services tech roadmap look like?
Absolutely. We've got a lot going on, because if you think about it, we're very interested in maintaining industry leading custodial platform. There are a lot of small to mid-size advisors who rely on our tools directly. There are also a large percentage of larger or more complicated firms who rely on us integrating with their technology effectively to drive workflows from their systems, not our systems. And so we really do have to feed both of those things. Additionally, we want to feed into this topic around wealth management solutions that we were just spending a lot of our time talking about. So we're thinking about it in a way, in a multi-pronged approach, where we want to make sure we're handling our custody services and continuing to make some enhancements available, whether that's through digital onboarding APIs or whether that's through APIs for money movements, right? Some of those heavy transactional volumes that advisors rely on us for, we want to make sure that we're building out that deeper bidirectional API infrastructure to meet our larger firms where they need us to meet them. So that's something we're pretty excited about, because we're going to go deeper there this year when we think about really enhancing some of those APIs to reduce data entry on the part of the RIA and really drive a lot more digital throughput. I think internally, we're also really focused on continuing to evolve our wealth management and our trading ecosystem. We've launched automated rebalancing and trading within iRebal, which is our rebalancing tool, which is going to make it a lot easier for advisors to manage their portfolios. And again, I think it's a feature we've been getting asked for a long time, is to really create some automation efforts around rebalancing as well as tax loss harvesting in that space. So it's exciting because we've also seen a pretty big uptick, 25% nearly growth in utilization of our model market center. And we're going to continue to invest in that and enhance that, making comparison tools available for advisors so they can compare model portfolios. We know there's a lot of demand for using them and for how to really compare those different portfolios to meet the needs of the advisors. So we're all in on really trying to develop some of those features and functionalities in the wealth management space. And then I think, banking and lending is another area of focus for us. Certainly when we think about tech, we know being able to deliver on some of those solutions in a cohesive way, much like we were talking about earlier. We know clients are asking their advisors for more. We want more than just portfolio management. Help us with the entirety of wealth management, which is inclusive of banking and lending services. We need to make sure that our tech ecosystem is able to display for the advisor information on both sides of that relationship. So what you'll see from us is a little bit more augmentation of transparency in the digital space around what clients are using from a banking and lending perspective, because we've seen a really enormous uptick in utilization of pledged asset lending, really 173% increase.
Wow.
In lines taken out by our clients of RIAs year over year for the past couple of years, which just indicates there's a need for it. We need to make sure that digitally there's some connectedness that allows the RIAs to see and participate in those conversations with their clients on that side too.
That's interesting. Do you have any idea why the securities-based lending service has grown so rapidly? I mean, is it just it's gotten easier and more available to meet the demand, or is the demand increasing?
I think it's a little bit of both, really. Some of it is that it got easier. Our processing and origination is down from multiple days down to minutes. So it is a really slick, largely digital end-to-end process. We've got over 90% of the applications for that happening digitally, which is really great. And I think the ease is factoring in quite a lot. But I also think that given the environment, whether it's interest rates and people are, not wanting to tap into a new line that's got some kind of really high interest rate, so they're tapping into their pledged asset line and using their own collateral to stand behind some of that. I think that's probably part of it too, some of the macro environment. So kind of both things are lifting the tide, but it's been pretty impressive growth there.
Trend that we hear a lot about, and I don't know if you have a view on it, is the advisors who are kind of finding that they need more investment opportunities beyond just the publicly traded markets, going into alternatives or other kind of private investment types. Do you see a trend there amongst the advisors you work with?
We do. And I always laugh because we keep joking internally. People always use acronyms and everyone keeps saying AI. And every time they say it, I say, which one? Artificial intelligence or alternative investments? So in the alt space, we are absolutely seeing an increase in demand there. And I think it goes beyond just point solutions that advisors have found, right? We've long had a lot of tremendous growth just in the alt space on the custody side of our business, where we are custodying alts that advisors ask us to do and to handle. There's been an increase in that. I think the realization that that's a way for advisors to demonstrate better returns, some optionality there, it's going to continue to grow. And I think this realization that maybe the standard is somewhere in the 4 or 5% allocation on a portfolio is moving north in many cases comes with some it comes with risk because many of these are illiquid, but I think what it does is it creates an opportunity for advisors to really be educating their clients about the merits of them, also some of the risks associated with them. And while they're doing that, they're asking us to really make sure that the way we support these are operationally frictionless, which we've got some work to do here. Obviously, alts come with subscription docs and a lot of operational heavy weight that come along with supporting those. And so I think the challenge for us is simplifying them in the same way that we've been able to simplify other types of work we support for advisors. I think additionally, they're looking for us to have better connective throughput and API integrations with some of the providers that they're leveraging out in the marketplace. And I think beyond that, the third point that we're seeing a lot of interest in is when are we going to be able to solve for alternatives in the construct of models, and how will that rebalancing activity take root? How will they figure out for things that are illiquid, how do you run a paradigm that accounts for that while still maximizing and optimizing the model that they're trying to run for the client? So I think it's all interesting and fascinating stuff, because solving for that at scale through model delivery is going to be a challenge for us. But I know many of the partners we work with are thinking a lot about this, and we want to make sure we're partnering with them to bring that to market and bring that to bear for advisors. Because again, it comes back to how much time you're spending sort of pulling these things together. And if you can automate components of that where it's going to cut through noise that you have to currently manually manage today, I think there's a real opportunity there with alts.
Yeah. You talked about the increasing the data throughput to some of the partners that advisors themselves might be using out in the marketplace for private allocations. Anything on the roadmap that you have for helping advisors vet some of these vendors or options? Maybe not specific vendor, but the types of investments that are out there. I've always thought it was difficult if you pull down a list of the private equity funds that are being shopped around and have space. How do advisors make any sense of it? Right? I mean, there's dozens and dozens of names and names of funds, and how do they? There's no Morningstar, right, for private equity yet.
Right. That's a huge opportunity, and even when we talk with partners like Case and I Capital, they're spending a lot of time thinking about that. I think from our perspective, we want to be able to extend that education and availability to advisors. But we also really like to honor the fact that it is the RIAs on the platform who really have to make sure they're educated and comfortable with that. So I think we want to enable it. I don't know that we ourselves will go directly into trying to solve for that or become the Morningstar of alts, anything of that nature. There are people out there working on that and doing it, and I think we're trying to stay close to it to understand how that's going to come online. Because to your point, if we want to see deeper utilization of alternatives beyond, say, the 30% or so of our advisors today who use it, which is the latest stat on what we see. We want to see that go more broad. I do think we have a role to play in making sure that education is there, those comparison tools are there, for the advisor to make the best decision that they can for their clients. So I think we can use some of our power to bring some of that online and make it available. But I think we'll also largely rely on those experts who are deep in that space, know it well, and are thinking through a lot of those challenges and opportunities as they bring new tools online.
Yeah, no, that's great. Exciting stuff for sure. Let's talk about maybe another hindrance to growth, I think, in the RA industry is the access to talent. We've talked about this before. Average age of the advisor is oddly not coming down dramatically, maybe a little bit, but for as long as we've been talking about changing that and getting new talent in and bringing in new fresh blood into the space, still kind of a problem. How do you view the war for talent there and where advisors are finding talent, or what kind of career entry points they're building or career pathing they're building?
Yeah, the talent continues to be always at the forefront of conversations that we're having. Benchmarking study that I alluded to before has signaled a need for over 70,000 new entrants to keep pace with the growth that our industry is seeing in the RIA space. And that doesn't take into account retirements, the aging out of advisors, new firms being stood up. That's just sort of looking at the population that we've got right now. So it's
say
a
that
real
number again. I'm sorry, say that number again.
70,000, that we need 70,000 new entrants into the RIA space as employees and owners of these firms to really keep pace with the growth that we're on track for. So it's a big number.
Incredible.
Yeah. And I think we see that largely and always RIAs have used personal and professional networks to drive this. And we still hear that. I would say over half of the firms we talk to are using still that personal professional network as their channel of choice. They are turning more and more to colleges and universities, which is great because I think we are all, Schwab, as well as all the RIAs we work with, are super committed to working with colleges and universities to bring greater awareness to the RIA industry, make sure that they have a footprint on these campuses where they can recruit talent directly, because that is a growing place to do some recruiting. And then we are starting to see more and more RIAs trading talent. Roughly 30% or so of advisors are telling us they are acquiring talent from other RIAs, which is not something that we used to see as prevalent as it is now. But again, with the growth, I think people are having to get creative about where they go to source talent. And they're also having to get incredibly creative about talent retention. So once you've got them, how do you keep them?
And do you see any trends there in terms of retention? We used to talk about equity a lot. Is that something that still is the big driver of retention, equity?
It is. I think what we've been really happy to see in our space is that probably 3/4 of RIAs are now offering official career path or progression opportunities. I think previously it was a little bit more of the stick around, maybe you'll get some equity. There's real meat in a lot of these career path and progression opportunities that RIAs are serving up. And I think the fact that it's also broadening out into beyond just becoming an advisor or a planner or then a partner, firms are growing. They're growing needs for technology. There are growing needs around enabling client experiences. So I think just the types of roles and the breadth of roles that RIAs can offer up to potential talent who may not just want to be on the traditional advisor track is going to help them as well. And so you're seeing that in some of the career path and progression trends that they're using and what they're building out. And I think we're really excited to see them leaning into that, because if they can demonstrate really clearly to the talent at their firm how they're going to help them grow, they're going to be willing to stay.
For sure. I just want to, and I know we're kind of running out of time here, but I did want to circle back to one point you made about the size of the industry, $9 trillion industry on its path to doubling. At some point, I don't know if you have some projections on when you think that's going to happen.
Yeah, we think probably over the next decade
Hmm.
is what we're anticipating, and that also means that if we are going to continue to gain our fair share, the overall pool needs to keep growing, right? And I think that there's still $37 trillion in assets outside of the RIA model. So it's a target rich environment for RIAs as well as for us in the custody business, because I think there's a lot of optionality out there. There are a lot of families and individuals that are not yet benefiting from fiduciary advice. And RIAs are going to need to really think hard about how they lead, how they operate, and really that scale question comes right into the forefront. If we're going to have a more than doubling in 10 years, what does that need to look like? What would an RIA need to believe to really make sure that they can meet those needs at scale while still honoring that deep relationship and trust that their clients give them, place in them? So it's exciting times.
Yeah, for sure. And you talked about the need for the 70,000 advisors. There are some RIAs out there, as you well know, that are on very, very, very rapid accelerated growth curves, right? They're acquiring firms left and right. They're growing rapidly, very fast. Uh, the 70,000 advisors that are needed, we talk about the number of advisory firms out there, the RIAs out there. Do you see that as these assets double in the marketplace under the RIA side, fewer firms handling those assets?
It's absolutely possible. I do think there are some inhibitors right now to brand new from creation in the form of complexity. Some of that ecosystem that they've got to navigate now, it's daunting. And I do think there's been a bit of a trend to say it might be easier to join forces with another firm who has some of the infrastructure and scale already ironed out while we continue to grow and serve clients. So I think it's possible, but I also think organic growth is really going to continue to fuel and be a big driver of what RIA firms are doing. And if clients are growing and retaining all the clients they have, which I think client retention for RIAs is somewhere like in the 97 percentile over the past decade. I don't know how much that will shrink. I mean, again, the opportunity set still seems to be big. I think the hurdle right now is just the complexity, the scale, and is it easier to join forces with somebody, or is it easier to run my own shop? And I think answering that question will probably depend a lot on what happens with technology over the coming years. But right now, I think you may see some consolidation. I may be not as bullish on consolidation as I used to be, given the rapid innovation that's happening here and solving some of the challenges that RIAs have been facing for a while could help really rise the tide too of just more new entrants into the market.
Interesting. That's interesting. Well, yeah, we're going to have a lot more to talk about, Jalina.
Exactly.
The next time we
It's
meet.
the story that never ends here.
You're
It's
right.
so
You're right.
interesting to
It's
watch.
it is interesting. It's great, and I appreciate your perspective. I know we're kind of getting the hook here. We're at time. I hope to speak to you again. Thanks very much for joining us on the RIA Edge podcast.
Always a pleasure. Thanks, David.
And thank you for listening. Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.